Welcome everyone to yet another webinar of from Marcellus. This is on our flagship portfolio, consistent compounders. We do these webinars on a monthly basis. So this is for the month of February. I know several of you had said in the last webinar, which was focused on the behavioral aspect of investing, the benefits of staying invested for the long run. Many of you had said that if you could spend some more time on our portfolio companies. So therefore, this webinar, this edition of the webinar is entirely focused on the portfolio companies, and it is also an appropriate time to look at it because we've just been through the results season. So there's a whole host of new information available. Some of which is noise, some of which is signal, as it is always the case with short-term results. To help us decipher the signal from the noise, we have our investment team led by Rakshit Ranjan, who's the portfolio manager of the Consistent Compounders portfolio. We also have a couple of colleagues from the investment team, Devin, who looks after some of our consumer coverage, and Sudhanshu, who looks after our coverage of pharmaceuticals and specialty chemicals as well. As you can see by these two gentlemen joining us, there are a couple of stocks in our portfolio which is giving us a lot of pain and sleepless nights. To give us peace, these two gentlemen will be adding a lot of color in terms of what their understanding of these companies are in the portfolio as we progress through the webinar. So to begin with, I hand it over to Rakshit. Over to you, Rakshit.
Thank you, Pramod. Good afternoon, everyone. Good evening. So the theme to this webinar that we'll follow is explaining how excited we are actually about the way the fundamentals of our portfolio companies are progressing. I know the word excited actually it might sound quite bold, but no, that's the reality. There's a lot that's happening. Many of the portfolio companies have completely transitioned from what they used to be until 3 or 4 years ago prior to COVID to what they have become now. And that has opened up newer opportunities in addition to their core business that existed till 3 years ago. And it's worth appreciating some of those transitions and also just to throw some light on how wide a disconnect that has created between current share prices and the fundamentals, which always narrows down. So talking about the disconnect first, so this is the performance of the portfolio. All the underperformance that you see, say for the last 1 year, is largely because of the last 6 months, whatever irrationality was there during the commodity rally of the first half of 2022 had reversed in the subsequent 3 months, and now in the last 4 months again there's underperformance. That's actually not the case with the fundamentals, which have not had too many concerns. In fact, only strengthening of the fundamentals, which is why when you look at this chart, this is the weighted average price to earnings multiple of the CCP portfolio. There's a 32% fall from where it was exactly a year ago. That's the degree to which these stocks have become, in a way, cheaper. At the same time, this is not without any transition in the businesses. As I said, businesses have only become stronger and better, and hence the jaw opening is quite exciting at many levels. Now, when it comes to taking some examples of how quickly the jaw closes, very quickly spending 2 minutes on that. So this is one example. Page Industries, many of you might remember 2019, particularly, which you can see in this middle segment of the chart, was quite a painful period when you looked at the share price trajectory of Page. Obviously, at that time, there were a few concerns on the reported fundamentals, but there was a lot going on underneath in terms of sort of changing the business's fundamentals structurally. The outcome of which has led to, say, the last 2-3 years, jaw opening, which happened during 2019, where on the one hand, the business was transforming, and on the other hand, the share price was languishing. The jaw opening, it closed very quickly. How quickly did it close? If you look at, let's say, the PBT progression, earnings progression versus the share price compounding, you can see it didn't take more than 4 or 5 quarters for doubling of the share price, because the fundamentals had progressed significantly ahead in the meanwhile. Now, in this case, as I said, the business was actually struggling a bit. So this is not the case of, say, many of our current portfolio companies where, say, an HDFC Bank, a Kotak Mahindra Bank, they are not struggling, but still the share. Hi, can you?
Yeah, we lost you for like 30 seconds, Rakshit. If you can just repeat the last 30 seconds.
Sure. Right. So this is Page Industries, the same chart that I previously showed, quarter by quarter. It took no more than 4 or 5 quarters for the share price to recover from its stagnation levels, and that's how quickly the jaw opening reversed. Now, in this case, Page was a bit of a struggling business, but that's not always the case whenever share prices languish. Here, actually, this was Dr. Lal Path Labs, a long 3-year period. Share price did nothing, and that was reversed in the subsequent 2 or 3 years. When you look at a quarterly performance of Dr. Lal on fundamentals and on the share price, here the disconnect was wide and open, right? So if you look at 2016 to 19, revenues kept compounding in the mid-teens to high teens. Profits kept compounding in the mid-teens to high teens. So if you look at March 18, December 17 onwards and go up, the PBT compounding was there, but the share price was just not in sync with that. And then came a 3-4 quarter period where from its stagnant levels, it became a 2-3x higher share price. Only because the fundamentals versus share prices, the gap narrows down. And this is a third type of example. Here, one single statement, and the funniest part was somewhere in 2019, in fact, where I remember the promoter of Bajaj Finance came on TV and said that during the World Cup cricket, the number of televisions sold in India wasn't as high as it was expected to be. And that one statement led to Bajaj Finance's share price falling by 20-30%. These corrections are nothing but opportunities to buy more, only if you have a very high degree of conviction on what's underneath the statements or the reported fundamentals. If the reported fundamentals are progressively getting stronger, if the future is getting brighter, then any of these corrections or sort of languishing share prices are nothing but times to get more excited about. In that context, coming to fundamentals now, this is from a long-term perspective, CCP versus Nifty 50. The gap is wide open and it sustains. When you look at returns on capital employed versus Nifty 50, the gap is as wide as say 20%. 42 versus 20. When you look at the PAT CAGR, profit after tax CAGR, on a 5-year rolling basis, the gap has never been narrower than 5 or 6%. On average, it has been as wide as 9%. And that's the reason why the portfolio that we are invested in outperforms over longer terms. Obviously, last 12 months was an aberration. It was not reflective of anything to do with fundamentals, which, as you can see here, continue going from strength to strength. This is a lot more recent quarterly results announcement. So 9-month FY23 revenue growth on average has been 20% year on year. Earnings growth on average has been 24% year on year. Obviously, we'll talk about one or two stocks where you see the negatives. But broadly speaking, whether you look at a 1-year CAGR, 1-year growth, or whether you look at a 3-year CAGR on revenues or earnings, it is not reflective of what the share prices have delivered over this time. In the longer term, not to forget, earnings growth is not where the fundamentals stop. They actually continue to accelerate when you move from earnings growth to free cash flow growth, and free cash flow growth typically tends to be about 5 to 7% higher for this portfolio. Now, I'll pass it on to Devin for a few stocks on consumer, and then we'll do the other sectors.
Yeah, thanks, Rakshit. Good evening, everyone. So I will start with Asian Paints. So it has been one of the highest allocations of our portfolio. So if you see the chart on the left, which shows the 3-year CAGR in volume growth. So despite being the largest player in the organized paint industry with a 50% market share, it has continued to be the fastest growing paint company in the last 3 years. And this growth has not only come on the back of market share gains in the core paints industry, but also addition of new product categories like putty, primer, construction chemicals. And linked to that actually is the chart on the right, where you can see the dealer network has almost doubled in the last 3 years and tripled in the last 4 years. Now, again, this is not only a paint dealer addition network, which they have done in the last 3 years, but they've also created a connect with a different category of stores like cement stores or hardware stores, which Asian was not present earlier. So this was possible only because they ventured into new products like putty, primer, construction chemicals. So overall, when we look at both the charts combined, we are very happy with the 3-year performance of this company. Nothing to complain. Now, when we come to slightly longer term decisions, which is more about the future, so there are 3 areas which are worth mentioning. The first one is the investment of 2,000 crores, which they have announced in setting up a plant for VAE, which is called as vinyl acetate ethylene resin. So VAE is a major component of raw material cost for any paint company. With this investment, once they start making this in-house, it will give them a sustainable cost advantage, which could be as high as 4 to 5% in terms of gross margin. Now, with this extra muscle which they are getting through this investment, it will not only add a layer of competitive advantage to their existing business, but also create a defense around the upcoming competition which is expected in the industry. The second type of investment is the 500 crores, 550 crores, which they have announced in white cement and white putty. Now, again, what has happened in the last 4 or 5 years, that purely on the basis of distribution strength of Asian Paints, they have garnered close to 20-25% market share in the white putty segment. Now, with this backward integration, where they have bought some limestone mines in UAE and putting up some putty plants in India, this will not only make the division profitable as a whole, but will also enhance the product quality. So with this extra advantage in terms of margins as well as a superior product quality, they are now even better equipped to fight the cement companies and significantly weaken their connect with the paint dealers. So the only connect which cement companies have with the paint dealers is through putty. And by attacking putty, Asian Paints is kind of trying to weaken the potential competition even before they enter the industry. And the third type of investment I would like to talk about is the home decor journey, which the firm has been for the last 5-7 years. So home decor is a 10 times larger industry than the paints industry. Purely on back of their existing paint dealer network, whom they are upgrading to set up some fancy stores for home decor. We have put a photo of one such store just to give you an idea of how the store looks like. With these kinds of stores and with the tech capability which the company has, where they will offer a 3D visualization technology to consumers. The target segment for this kind of market is not people like who can afford architects or interior designers, but there is a large set of consumers who cannot afford designers and architects. And for them, this technology, along with a convenience of having all categories of home decor under one roof, the attempt is to formalize the home decor industry, which is quite fragmented. And no other building material company has this kind of dealer network or contractor connect to execute this business at the scale which Asian Paints is attempting. So by end of this year, they will have 75 home decor stores across India. And this already forms almost 4% of their decorative paints business, which is close to 1,000 crores. Coming to Berger, so a lot of investors keep asking us that why don't we talk much about Berger and only talk about Asian? So it's obviously a smaller allocation than Asian, but the firm has matched Asian in terms of growth rates consistently for the last 5-6 quarters. In fact, in the recent quarter, it has even beaten Asian Paints in terms of growth rate. And just to put this in context, just in the first 6 months of FY23, this firm has increased its market share from 18% to 18.8%. With the kind of growth which they have given in Q3, this 18.8% number would be even higher for Berger Paints. So if you can go to the next slide. So it's not just the short-term growth rates or the last 3-year growth rates where this company has matched Asian Paints, but also long-term initiatives. So like Asian Paints, obviously the dealer network for this firm has went from 36,000 dealers to 50,000 dealers, and the tinting machine base has increased from around 30,000 to 46,000. So a 50% increase in the tinting machines which they have in the market. And as we have explained many times in the past, a tinting machine creates a strong defense for a particular paint company in that paint dealer shop. It's very difficult to displace or take away market share from a company who has placed its tinting machine in the dealer shop. And in FY23, they have not only added tinting machines, but rather they have increased the addition of tinting machines by 2x. So till 2021, Berger used to add roughly 3,000 tinting machines in a year. In 23, they have added close to 6,000 tinting machines. So again, a very good way to create a defense against the upcoming competition. And coming to slightly longer term initiative, which has been a major milestone for the company, is the supply chain automation tool or supply chain tool which they invested in last year. So the supply chain has almost kind of gone a complete transformation in the last year. So Berger Paints implemented a software provided by a firm called O9 Solutions. So this is the same firm which provided software supply chain tool to Asian Paints 20 years ago. Now it is called as O9 Solutions. So one example of what will change with this software is demand forecasting in Berger was a kind of manual exercise where the depot manager will sit with his colleagues and make a demand forecast for a particular area. Now with this, with implementation of this software, that part of the exercise is completely automated. And the secondary effect of this automation is that it will also help Berger to plan their production in a better way and hence plan their raw material procurement in a better way. And we expect to see tangible outcomes of this in form of margin expansion and reduction in working capital days. This is a slide which shows the growth rates for all the listed paint companies in the last 3 years. As you can see, Berger and Asian Paints are neck to neck and way above the larger competition. Coming to Pidilite, so again a company which has gone complete transformation in the last 3-4 years. So till about 2017 or 18, Pidilite was a company which was highly dependent on Fevicol and Dr. Fixit. And they also kind of faced impact of that when macro was weak in FY 17-18. It was also a firm which was underinvested in technology. In the last 3-4 years, again, with a lot of investments which have went into technology, strengthening the HR policies of the firm, as well as many other initiatives, we can see that the sales and distribution has expanded by 70%. So they are now covering 70% more towns than they covered in 2020. Close to 500 crores have been invested in setting up 24 plants across India. And this is not just for Fevicol or Fixit, but for many other categories which they have entered, which I will show in the next slide, and various supply chain automation and technology projects, which will help them generate operating efficiencies. And lastly, they've used digital in a beautiful manner. So Pidilite has mobile apps for every type of dealer, retailer, or users of their products like carpenters, plumbers. So it's close to 3.5 lakh dealers use Pidilite's app on a regular basis. And contribution of this mobile app to their business has increased from 3% in 2020 to 15%. So what this means was, earlier a salesman used to go to a dealer to take orders manually and then pass it on to the company. What this meant was, because the salesman visited, say, after every 10 days or every 7 days, if the dealer had any requirement in the interim, Pidilite would lose out on sales, or if a competition came in, they got an entry. With use of this mobile app, the dealer can order Pidilite products whenever he wants. This means that because as the dealer gets habituated to use this mobile app more and more, Pidilite dealer, probably if he was visiting the dealer once in 10 days, he can start visiting once in 15 days, and this way improve the productivity at his end. And coming to the final piece about product innovation. So product innovation and training the users on new products has been the biggest strength of this company. So we have given here some examples of the new products which they have launched in the last 2 years, or some categories which have been scaled up meaningfully in the last 3-4 years. In the core business, as you can see, so one of the product I think worth mention is Home Fix. So this is a product which can be used to stick anything on the wall. There is no need to use a nail to drill a hole in the wall and then put a nail in it to hang a frame. You can simply use this product. In growth categories, so growth category defined is any category which grows at 20-25% for the company. Till 3-4 years ago, the only growth category, meaningful growth category every one of us was aware of was Dr. Fixit. In the last, again, 3-4-5 years, it's not just Fixit, but Roff, Araldite, ICA Pidilite, WD-40, Nina Percept. All of these new brands have been added to the growth category. So there are close to now 6-7 brands in the core category, in the growth category of the company. One of which I think the biggest one being Roff. So Roff, again, it's a superior alternative to the traditional method of using cement and sand to fix tiles. So this is a highly underpenetrated market, but a highly efficient way to fix tiles. And our channel checks suggest that it's seeing a rapid adoption amongst the mason community. And finally, it's not just about the growth categories. They're already seeding some categories which might be future growth categories. So one such category is Feviseal, which is a brand for sealants market. Again, a 600 to 800 crores market. And sealants are used to stick anything, anywhere. If there is a gap in tiles, you can use a sealant. If you want to fix a mirror, you can use a sealant. So there are n number of uses of sealants. And finally, a very innovative product, probably the first time in India, which they are launching with one of their joint venture partners called Grupo Puma. It's called Unofin. So the product will replace plaster, putty, primer, paint. So it's kind of all-in-one product. Obviously, it will be a premium product, so will be used mainly at premium construction sites in the initial days. The turnaround time is of crucial importance. And because this is a very new product, it's currently the firm is currently training the applicators on use of this product. So coming to Page. But before coming to the growth rates, I would first like to dwell a little on the Q3 FY23 results, the recent results, where we have seen a 3% YOY growth in revenue. This looks optically lower. This looks lower, but there are two optical reasons for this. One reason is that there is a high base of athleisure in last year because everybody was sitting at home, and in general the category was in a boom phase. A lot of athleisure was sold last year. Now, as activity has started, people have started going back to work. Athleisure sales have dropped. So the correct way at looking at sales CAGR at sales growth for this firm would be to look at on a 3-year CAGR basis, which is close to 17%. The second optical effect is that of auto replenishment system. So there has been a destocking of close to 7 million pieces in the distribution channel because of implementation of auto replenishment system. What auto replenishment system means is that distributor is selling to the MBO, but company is not refilling the distributor. That is because they want to lower his working capital investments. So if we adjust for this optical effect, which is reflected in the reported numbers, the volume growth would have been higher by close to 10 to 12% for this quarter. So if we can just go back to the first slide. So if you can see the right hand side of the chart, this firm has grown its sales on a 3-year CAGR basis at close to 17% on an average. And this is despite the optical effect of ARS implementation. And ARS this quarter, although was implemented only for athleisure, it was implemented for men's innerwear long ago. So in the last 3 years, there have been 2 instances of ARS implementation, which is kind of optically pulling down the reported sales growth rate. If we adjust for that, our sense would be that this firm has grown its sales at close to 20% over a 3-year CAGR. And coming to the, I think the underlying reasons for the solid growth which we have seen in the business, one of the biggest reason, as we have repeatedly mentioned, is the technology investments which they have done in the business to accelerate, to widen the product portfolio as well as accelerate the distribution expansion. So look at any format, whether be it MBOs or EBOs, every format has grown by almost 2 to 2.5 times in the last 4 years. Coming to Titan, again, I think one of the highest allocations in the CCP, and I think we have no complaints with this company. It has delivered a very healthy sales CAGR of 21% over the last 3 years. 3-year CAGR of 21% over the last 5-6 quarters, and the EBITDA growth has been close to 27%. This is largely led by the jewelry division. So it's delivering on expected lines, the trust advantage, the Tata name, the designs, the superior retail experience. All of that is leading to the consistent growth in jewelry. I think worth mentioning, the star performer in the portfolio has been CaratLane. So this business has tripled in the last 3 years. And through this business, we think this is a very great value add for the firm because CaratLane targets a type of consumer which could not have been targeted through Tanishq. It's a relatively young consumer who is wearing, using this jewelry not as an occasion wear, but as a daily wear. So completely new type of consumer, completely new type of merchandise. So we think that this is a very good addition to the firm. And it's not just growing at 50% CAGR, but this has also turned profitable through COVID. So trailing 12 months, the EBIT margin of this company is close to 6%. And unlike the typical startups which we see, this firm is not just making profits but also making a return on capital of 20%, which is higher than cost of capital. Uh, Coming to some say other non-jewelry divisions. So eyewear again, it struggled for close to 10 years now, but the model has been fixed. There's a new leadership team running eyewear. So in the last, I think 5-6 quarters, they have consistently delivered the EBIT margin of 18%, and that should ideally reflect in faster sales growth since the model has been fixed. Well, we do not see any signs of saturation in jewelry. This firm is already seeding some new categories. So Tanaira, again, I think ethnic wear brand. It's again a 1 lakh crore market by estimates, highly fragmented, similar to jewelry. The store count has grown by almost 12x in the last 4 years. They've also recently launched a new brand IRTH for the handbag category. Coming to Dr. Lal, so I think if you look at the table on the right, this company has been the fastest growing company in the organized diagnostics industry for the last 3 years. And never has been the gap between Dr. Lal and the other 3 companies so wide, which we have seen in the last say 3-4 quarters. And these are 3-year CAGR numbers because last year was a COVID base, hence we have taken a 3-year CAGR number. And these 4 players are almost cover 50% of the organized industry. And if you add players like say Suraksha, Vijaya, Newberg, Aarti, all of these top 7-8 players would account for roughly 70-80% of the organized diagnostics industry. And all players have grown at similar rates over a 3-year CAGR. So that's about Dr. Lal in the organized industry. Secondly, I think a lot of concern has been about entry of new competition from online players. I think we are already seeing signs of that competition weakening. So last year, sometime in Feb, M-Fine, which was a online company selling diagnostics at cheap rates, it went bankrupt. In the last 2 quarters, we have seen as Pharmacy has shifted their focus to profitability and decided to reduce their cash burn, their diagnostics business is degrowing on a quarter-on-quarter basis. At the same time, 1mg has reduced their price aggression and talking about focus on profitability. So the online competition is weakening. The only concern I think anyone could have on this business is why the fastest growing player in this industry is still growing at 13%. Now there are 2 possibilities. One possibility is that the market share gain rate has slowed down post-COVID. One of the reasons for this is during COVID, because the demand was free-flowing, a lot of smaller labs invested in RT-PCR machines and they had a windfall gain during COVID, just like Dr. Lal had a windfall gain during COVID.
So just to, sorry to interrupt, Devin. So just to give some perspective on this, the overall diagnostics industry is around 90,000 crores or higher than that. 90% of it is controlled by the government labs and mom and pop labs equally. So effectively, the organized industry is only about 10% or slightly less than that. Now, this organized industry offers massive value add to customers, to doctors, because of which the market share gain from mom and pops to the national players is actually a structural market share gain, right? This is one of the biggest drivers of high growth of organized players, which had been around 14-15%. What Deven is talking about is effectively in the last couple of years, the footfalls of RT-PCR testing for a mom and pop lab also has been reasonably high, and the cash flow that has come as a result has given a lifeline to these smaller labs to last for a bit longer before some of them hang up their boots or others give away market share to the likes of, say, Dr. Lal Path Labs. This is a temporary phenomenon. It's been 12 months now since the last wave of RT-PCR tests footfalls, and very quickly you'll see the effect of this on industry growth rates waning out.
Yeah. So that's the first possibility for lower growth. The second possibility is that channel checks indicate that so there are these highly reputed firm like IMS, which do some research on macro data in the healthcare industry. What that suggests is that after any pandemic, and this study has been conducted in South Asian countries mainly. So after any pandemic, for a period of close to 1 to 2 years, there is a drop in number of ill patients in that country. Now, there are various hypotheses why this could happen. One of the reasons is that there is immunity which has been created due to vaccination or medication, which happens during a pandemic, or it could be because patients have become more preventive or more cautious about their health and hence taking care, or it could be simply be that because there was a pandemic, there is less activity in the market, people are going out less, and hence there is a drop in number of ill patients. But again, it's a temporary phenomena. It tends to last for around a year or so. So again, both possibilities which we think are again temporary in nature and not structural. And coming to say Dr. Lal specific, so this is a business which is much stronger than what it was close to 3 years ago. Some of the initiatives which they have taken is, one is building a D2C online business. So the firm has invested in a lot of technology, has hired a lot of talent to build this business. Their app has been upgraded. It will get upgraded even more. They are now working on search engine optimization, which was a new thing for the company. This way, they will prevent online competition to again enter in future if they come at all. The second type of initiative is strengthening the B2B business. The B2B business in diagnostics is mainly the business which is when the smaller labs outsource their samples to bigger labs like Dr. Lal because they don't have the machinery to do that test, or hospitals outsourcing samples to Dr. Lal because they don't have the machineries in-house. Dr. Lal is creating tech solutions to deepen their connect with these B2B clients. So one such initiative which we expect will happen in the next 1 year is integrating APIs, basically Dr. Lal's system with the hospital system. So as soon as a report is generated in Dr. Lal's lab, it will automatically reflect in the ERP which is used by hospitals or doctors in hospitals. Second can be say digital interface for B2B clients, because as relevant is TAT for retail customers like us, B2B clients also give a great importance to turnaround time of the sample, because there is probably a patient admitted in the hospital who is waiting for a surgery. So they want the report as soon as possible to start operation on that patient. So giving a digital interface to B2B clients gives them an added layer of comfort where they can track where is the sample in the journey and how much time can be expected for the report. And we have spoken of investments like, control tower in the past. So control tower is nothing but think of it like a air traffic controller tower where 20-25 people are sitting in a room in Gurgaon, and they are getting end-to-end visibility on any sample journey. So they will know when the sample is picked up from the collection center. They will know where is the sample in the journey to the lab. They will know where is the sample in the lab and whether the report is generated. Because of this end-to-end visibility on entire life cycle of that sample, the expected ETR, which is basically how many reports do you give on time, that number has gone up from 80% to close to 90% for Dr. Lal, or above 90% actually. So again, these are investments which are made with a very long-term horizon. This is probably one of the investments which will pay them as they keep expanding. Coming to Suburban, which has been a recent acquisition. So like any M&A which happens, the last 1 year in Suburban was mostly spent in stabilizing the team, integrating the systems of Suburban with Dr. Lal, converting the owned centers of Suburban into franchised centers, and launching the new reference lab in Mumbai. Now, all of that is done. The new reference lab, which they have launched in Mumbai last month, that increases the test menu of Suburban from 700 tests to 2800 tests. So a 4x increase in the test menu. Now, this was needed before they started scaling the front-end expansion because without a lab, expanding the front end won't make any sense because your TAT will get impacted. Now that the lab is in place, the focus will be on expanding the front-end infrastructure, which is in form of collection centers and their own centers. And the third point, I think, what will be their strategy with Suburban. So the strategy with Suburban is very simple. Focus only and only on expanding the collection center network in West India. So, and that will automatically drive profitability for Suburban. So a ratio which is very interesting to note is that for every lab, Suburban has 4 collection centers. The same ratio for Dr. Lal is 16 or 20 close to, which means that every lab is getting sample from close to 20 collection centers. Now, what this means is as more and more collection centers get added around the hub, which is the lab, the lab will be, the sweating of the assets in the lab will happen at a faster rate, and that will drive the operating leverage in the business. And second unique thing about Suburban is that Suburban has been known as a corporate wellness brand in Mumbai. So they have many centers in almost every suburb of Mumbai, which offers a pathology along with basic radiology. What this means for Dr. Lal is that this kind of creates a differentiation for them. So no health checkup is actually complete without some element of radiology. So, there is probably a test like echo that is very crucial if you really want to get an exhaustive health checkup. Because Suburban has this capability, they have the infra. This will be leveraged by Dr. Lal to grow the corporate wellness as well as the premium wellness business in the west part of India. So net, much stronger firm than it was 3 years ago. Suburban has been a major capital allocation decision for the firm. We think they are on the right track with Suburban and seeing all the positive signs.
All right, thanks, Devin. So from the consumption sector, let's move on to another lab which is not in consumer, Divis Lab. This has also been a stock which has attracted lots of questions towards us from our clients more recently, given its share price performance. Sudhanshu is our expert. Sudhanshu, over to you.
Yeah, thank you, Rakshit. Good evening, everybody. So first of all, I would like to summarize the recent results for everybody's benefit here. In the most recent results, which was Q3 FY23, Divis reported an 8% QOQ revenue decline with around 700 basis points compression in margins. The stock reacted to that announcement, and that's where this chart probably helps us understand the situation a little better.
Yeah, so let me give you some context on the chart actually first. Divis has had in the last 15 years 4 instances of sort of 40 to 50% correction in the share price on a year-on-year basis. Interestingly, all of those 4 instances have been because the quarterly revenue run rate of Divis has become negative for 2-3 quarters in a row. Now, it's quite remarkable to see how high the run rate of quarterly revenue growth tends to be when it's not negative, it's typically 40-50%. There are lots of consistent periods of several quarters of that run rate, and then there is the lumpy fall. This is actually not because of any external environment or competitive environment. This is because of the nature of the business that Divis is, which is where I think what Danshu can add value to is going to be helpful.
Sure. So, as most of you might be aware, Divis is basically into manufacturing of pharmaceutical APIs. Now, in their business, they've got two segments. One is custom synthesis, where they make particular molecules for specific clients, largely innovator companies based out of America and Europe. And the second is generic API segment, where they make their own APIs and sell into the open market. Now, the nature of the business is such that in custom synthesis, there are periods where they get very high volumes by high demands, but then these are followed by certain lull periods where some of these molecules probably are retreated at the end client's market, or there are certain projects which are delayed by the client and the requirements for those molecules are impacted at Divis's end. In the recent results, while the revenue, etc., were basically in line with our expectation, the margin compression was something of a negative surprise. After these results, we did a deep dive on both the segments for Divis, custom synthesis as well as generics. And we believe that the compression in margins as well as the basically lowering of rates in terms of revenue growth are more of an aberration rather than anything structural or any issues with the capabilities of the firm. Now, our conviction is based on a couple of activities that we did at our end, and I would like to highlight some of them to you to understand this aspect better. First, we assess the volume and pricing trends for the key molecules that Divis sells in its generic API division. And we understand that in the last 3 months, the prices have largely stabilized. We also see double-digit volume growth in many of these APIs, which indicate that the underlying demand for these molecules is turning back after basically a couple of quarters where it was slowed down. Secondly, we spoke to many critical supply chain executives in the Western pharma industry who are essentially the decision makers for outsourcing decisions for these companies. And we understand that when it comes to small molecule APIs, Divis is one of the preferred suppliers for a large number of them. Now, Divis's status as a preferred supplier is based on many capabilities that the firm has developed over the years. To name a few, Divis has been consistently good in supplying full quantities at committed times, irrespective of the external environment. So just to give you an example, in the last 2 years, all the experts that we spoke to have consistently maintained that Divis never called them anytime during the last 2 years, saying that our consignments of raw materials, etc., have been stuck at Shanghai port and hence we can't deliver to you. So this builds confidence, and this business in custom synthesis is a lot about confidence. Second, when it comes to the capabilities to scale up products from probably lab scale to large scale production, Divis has demonstrated time and again that it is more than capable to do it. As a matter of fact, it is rated amongst the best in the industry, probably behind Lonza to say, and that is saying something. Third, basically, when it comes to the compliance aspects, Divis has always had a very good track record. They have been amongst the best in this industry in this regard as well. Finally, when we see the new product pipeline of many of these clients where Divis is a supplier, we see a lot of molecules which are into the relevant categories which fit the Divis capabilities are at advanced stages, phase 2, phase 3, or commercial approvals awaited. And this creates the right, probably, environment for Divis to capitalize on its trust and relationship with its client to get those contracts and start supplying. Now, these are long gestation period projects, and hence the commercial supplies, etc., from the time of negotiations and actual delivery takes typically between 6 to 8 quarters. But fundamentally speaking, Divis has strengthened its position through COVID with all its clients. It has also undertaken a lot of initiatives at companies' end, both in terms of expanding the kind of molecule this is producing. It is entering into contrast media, which we talked about last time as well. 2 of them basically are at advanced stages of regulatory approvals and client approvals. One of them is expected to start commercial supplies in this quarter, and the significant ramp up in both of them should come in Q1 of FY24. In the generic API side, company has already filed several DMFs with the Western regulators. They are awaiting some of these clearances from regulators as well as patent expiry for some of these molecules to start the commercial supplies. Divis is also investing in new technologies like flow chemistry, vapor phase chemistry, etc. Beyond adding the capabilities to manufacture something, these also add capability to improve efficiencies of utilization of resources like solvents, etc., which would improve the margin profile for the company. And finally, a big positive in the recent result was basically company finally got the approval for its acquisition of land for Unit 3 at Kakinada. Now, this would not only help us or help Divis in terms of expanding manufacturing capabilities and the base, it also helps them diversify their risk of manufacturing sites. If something untoward to happen, either on terms of any uncertainty related to natural calamities, as well as any regulatory issue that they might face at any point of time. But this would be a big diversification and risk mitigation activity on Divis's part.
Thank you, Sudhanshu. Moving on, Bajaj Finance is another large position. More recently, the share price has been a little weak. It is a lot better than where it was about a month ago, and we've increased some exposure to this. The reason why we stay quite convinced is actually that this is, again, just like many of our other firms that Deven and Sudhanshu talked about. This is a business which has transformed from where it used to be 3 or 4 years ago. The best way to understand that transformation is what it is doing beyond just the lending part of the business. And in that, the best starting point is the existing customer mix. So existing customers are around 2/3 to 3/4 of new loans issued by Bajaj Finance. Now, that has always been one of the strengths in the past, and what it is doing with that strength is quite remarkable. If you look at the assets under, the loan book per cross-sell franchise, which is sort of AUM per cross-sell franchise, right? That's the loan book for the lender. Loan book per cross-sell franchise has grown up at about 3% CAGR in the last 5 years. What's very interesting is that despite just 3% loan book growth, PAT per profit after tax per cross-sell franchise has gone up at a rate of 14% annually. Right now, when this then gets added to the new customer franchise addition, which is about 20-21%, that's how you are actually now getting a total profit after tax compounding, which is far less reliant on lending more and more to the existing and new customers, and far more reliant on generating greater profits out of non-lending activity as well from the existing customer base, right? So if you look at the core fee income as a percentage of AUM and PBT, they have ramped up quite meaningfully in the last 4 or 5 years. Needless to say, the profit after tax growth as a result has been very healthy. Chart on the top shows you the consistency of some of the key metrics there, and chart on the bottom shows you how that boils down to ROA, ROE, which are sort of amongst the best in the industry, despite very healthy balance sheet, reasonable leverage, and high capital adequacy ratios. I think this is a firm where every 2 or 3 years it adds newer lines of business, and with the fintech initiatives that it is taking now, it's actually moving in a completely new direction with the existing customer base. This is a great exhibit to understand how, if you were to buy from Bajaj Mall a Samsung television or a Whirlpool refrigerator, you'll actually be able to buy it at a price cheaper than Amazon, and that's the kind of value add that customers of Bajaj Finance are getting, which is where the business's profit after tax compounding is in a way far healthier than it ever was through only lending previously, and to lending plus fintech now. Very quickly, a couple of other lenders. So HDFC Bank, it has actually never had a very weak loan book growth throughout the last decade. The vertical bars here are just exemplary. The strength of the loan book growth compounding, the consistency of that is remarkable. Returns on asset very healthy and inching upwards gradually as the business has become more and more efficient. What's quite remarkable is the chart at the bottom, right? So these phases of dissonance where share price growth lags behind fundamentals are followed by phases of resolution where share price growth leads ahead of fundamentals. We are going through one such phase of dissonance where in the last 3 years, share price growth of HDFC Bank has significantly lagged behind fundamentals. And you don't need to be extremely smart to figure out what will happen after this when the phase of resolution is followed by the phase of dissonance. Very similar sort of exhibits for the third lender in our CCP portfolio, Kotak, where again, these phases of dissonance and resolution have been there in the past as well, and likely to be the trend going forward, given how fundamentals have progressed in the more recent past. Kotak's loan book growth and profit growth in the last 2 or 3 quarters, particularly, has been amongst the highest in the banking industry. And even in the most recently reported quarter, I think it was more than 30% profit after tax growth. Right, so going from strength to strength, and very quickly, in the interest of time, HDFC Life Insurance. Our colleague Tej has talked about this in KCP webinars. Very quick summary. The only incremental weakness that happened in the more recent weeks was around the announcement in the budget of tax breaks not being available to customers paying more than 5 lakh insurance on non-ULIP policies, etc. We've spoken to lots of people in the ecosystem to understand what are the solutions to this that tax break oriented customers are resorting to, or what are the reasons why there is actually lack of elasticity towards tax breaks from the kind of customers that pay this. Net, it's a reasonably small single-digit percentage of the portfolio of HDFC Life that can be expected to be exposed to this. Otherwise, when you look at, let's say, the January numbers, where the market share gains reported by HDFC Life were the highest compared to anyone else in the industry, the company continues to grow at a rate much faster than its peers, and with a quality much better than its peers. In terms of ICICI Lombard, the non-life insurance firm in our portfolio, again, very healthy set of fundamentals progressively. Now remember, this is not a company which will do every line of business at any point of time, and hence there will be periods like what prevailed until about a few quarters ago, where it would avoid businesses that are not profitable. Underwriting quality matters more than just selling and revenue growth to this company, and hence those decisions eventually lead to very healthy balance sheet and healthy return ratios in the longer run, which is why we are convinced about this. So that's it really, and I'll open the webinar to Q&A. Pramod, we can take a few questions maybe at this stage.
Sure. Yeah, so there are quite a few questions. I'll start with the portfolio level questions and then go to some of the stock specific questions, some of which we've already covered, but perhaps for greater quality, we can look at that. So first on, the usual questions around the performance of the portfolio. So one is saying, to Rakshit's point, that some of the portfolio stocks can have an off period so long as business fundamentals are in place. But why is it that almost all the portfolio stocks are simultaneously having an off period? Doesn't that concern you? Business performance may be creditable, but doesn't count much if not backed by stock performance pretty much for the entire portfolio. And related to that is another point that, I've another question from another client saying, I've heard that high PE stocks suffer in high interest rate regimes. So does that sort of explain the underperformance despite the fundamentals being relatively creditable.
Right. So the knee-jerk reaction to rising interest rates, obviously, especially the capital flow effect, where capital moves away from equities into bonds, and this is going to have a bigger effect on longer-term equities, where tail of the cash flows is longer, where longevity is discounted into the expectations and the current prices and intrinsic values, compared to other businesses which might have a lot shorter time horizon of an investor's expectations around fundamentals. Yes, it is true that the longevity-oriented plays will see the knee-jerk reaction of capital flow being more adverse than for the others, but this ends up being short-term, and this is actually something that you could have argued that prevailed in the first half of last year largely, but thereafter, in the longer run, high quality business to begin with, if there is no exposure to debt where cost of capital increase affects fundamentals, if there is no exposure to any other source of funding where cost of funding going up affects fundamentals. In fact, companies which in our portfolio are beneficiaries of their competition becoming weaker due to cost of funds going up for the competitors. Right? In the best example, for instance, some of the diagnostic companies that Devin talked about, which were getting capital at cheap rates, those interest rates have gone up, competition has weakened, and market share gains have accelerated. Right? In such cases, higher quality businesses actually they don't get affected on the business front by rising interest rates. Now, it's not that the DCFs around the world were factoring in sort of 5, 6, 7% discount rates until a year ago, and now the discount rates will be sort of 14, 15%. Discount rates in the DCF are opportunity cost of investing in equities rather than the cost of debt only. Remember, it's not that the DCFs are representative of the risk-free rate only, right? So to that extent, the opportunity cost of investing in equities, in a way, is not something that changes materially. On the contrary, when it's a rising interest rate environment, the ability to retain returns on capital employed above cost of capital and maintain that gap, that ability is far stronger with higher quality businesses and far weaker with competition. So knee-jerk reaction, yes, and probably that's the reason why quality in general across the world, it takes a beating for a few months if this sort of a macro change happens, but that's temporary. Separately, also worth noticing, whether it be because of macro or sentiment or something else, phases of irrationality where disconnects between fundamentals and share prices emerge for the entire lot, not just for a single stock. These phases do appear over a 3 to 4 month time period, once in 2 or 3 years, and then they reverse. But yes, once in a decade, there have been phases where the disconnects have prevailed for longer than 12 months, the disconnect between fundamentals and share prices for a basket of stocks rather than a single stock have prevailed for longer than 12 months. If you attended our last webinar, we showed you how this happened actually once about 11 years ago and another time about 21 years ago in India, across the world. So it's a relatively infrequent occurrence, but this is not the first time it is happening, and this subsequently does reverse. Right.
So related to that, Rakshit, is also the point about price to earnings multiple. The question is very nuanced. The question is, if the fundamentals are so good and yet the stock price is not catching up, does that mean that the better fundamentals are already priced into the stock? What do we see in these stocks that we think that the market can't see, because if we compare the price to earnings multiples of our portfolio versus that of the Nifty, clearly the market is already giving full credit to these superior fundamentals to our companies.
Right. So the intrinsic value, which is the fair value of the companies that we've invested in, is significantly higher than where the current price to earnings multiples have been. So a 10-20% up or down move in the share prices, it doesn't significantly change the gap between intrinsic value and the share price. The intrinsic value in many cases is 30, 40, 50, 60% higher than the current share prices in our portfolio. Now, why is that? The reason why these stocks are cheap at these punchy PEs, the reason why these stocks are cheap at punchy PEs is because the market isn't adequately factoring in the sustainability of healthy rates of cash compounding, free cash compounding, right? It is not that these companies will stop compounding over the next 3 or 5 years, and then there's massive uncertainty, which you have to factor that in. Provided you dig very deep and be convinced that there is no uncertainty for moderation in cash flow compounding run rates after 3 to 5 years, the longevity of healthy rates of cash flow compounding is what is the biggest source of undervaluation, which is where, if you notice, all the stocks that we talked about, rather than just focusing on what's going to happen next year or the year after, initiatives being taken that will fire up sustainability of greatness of these companies into the next 10, 15 years or longer is what is worth focusing on. That is what has helped these companies compound in the past as well, right? So it's not that had you bought a Bajaj Finance in 2015, it was available at 2 times price to book. That is absolutely not the case. Even in 2016, 17, 18, a Bajaj Finance was available at very similar price to book multiple as it is today. And even in 2016, 17, 18, looking at those PE multiples, price to book multiples, many investors did avoid investing in a Bajaj Finance because they thought that, well, this is the highest valued PE multiple compared to its peers. It is trading at a value which is significantly higher than 10 years ago. And 10 years, well, in the noughties, Bajaj Finance was actually a much weaker business. And hence many investors, they avoided it because the good news is probably already factored in. That was proven wrong. And for the same reason, if you believe that the current PE multiple of these high quality businesses adequately captures all the upside, then we believe the investors will be proven wrong on that, because the intrinsic values are going to be reflective of longevity, not just what the share price currently is factoring in.
Right. So, I kind of like this question. It says that, look, thanks for sharing a lot of information about your portfolio companies and the conviction you demonstrate. It's great to hear that. But you also end up exiting some of these companies, like we exited an Abbott or a Relaxo. So despite having these strong convictions, if we end up selling a stock, how should we read that? How should we read the long-term holding period or holding power when we had just demonstrated so much conviction?
No, that's a very good question. So there are 2 main reasons why we exit from a company in our portfolio, in CCP particularly, and also applies to all the other portfolios that Marcellus manages. Reason number 1 is an absolute deterioration in our expected rate of compounding or longevity of the business, its competitive positioning, and the competitive advantages, right? So Abbott was that sort of an example. We exited from it in Jan 22. And the reason why we exited from Abbott was not because we expected something bad in in the fourth quarter of FY22 or the first quarter of FY23, nothing like that. But in the preceding 6 to 7 months, in fact, Sudhanshu was the analyst, and Sudhanshu made us realize that look, when we are speaking with the ecosystem partners of Abbott, we're realizing that to begin with, one of the largest revenue contributing drugs, Dufaston, in fact, saw a massive price war from a new competitor, and Abbott let its market share go away. That was followed by our realization that several CXOs, they left to join competition, and that was further leading to us understanding that the parent's approach towards the listed entities pipeline of new products into the future is likely to be far weaker than what it was previously, or what we had expected. Now, these three things, in effect, they lead to a massive downgrade in our expectation of number of years for which Abbott will compound at a very healthy rate. That downgrade led to the intrinsic value of Abbott fall significantly in Sudhanshu's models, and that's where it made sense to exit from this, because the margin of safety and sustainability was gone. It was not there anymore. So that's the reason number one. Out of the 4 exits that we've had since inception, I would say 2 out of those 4, in fact, no, sorry, 3 out of those 4 have been because of this largely. The 4th exit, which was Relaxo, which you asked about in the question, that's a stock we exited from Consistent Compounders in September 21. And the reason for that exit at that time was because one of the other stocks in the portfolio, which in that case was TCS, underwent a massive upgrade internally. Again, not for the next quarter or the quarter after's earnings growth expectations, but for the longer term of TCS's expected free cash flows and earnings. And that upgrade in TCS led to the margin of safety on TCS becoming far wider than what it was in Relaxo. And in such a situation, as a fund manager, you have 2 options. Either add TCS as the 15th stock, and that will lead to one day you becoming a 16, 17, 18, 19 stock portfolio if companies in your coverage are going through upgrades on an ongoing basis. Or there's a second option, which is that concentration adds significant alpha over long term to shareholders, and that or to investors. Concentration in a portfolio, which is 13 to 15 stocks in CCP, has to be maintained. And hence, rather than adding one new stock every time it goes through an upgrade from the coverage universe, it makes sense to replace one of the weaker allocations, one of the weaker companies in a relative way with this new entrant. That's what we did with Relaxo. So yes, that's in a way, in a nutshell, our sell approach, which is very important. I mean, there are lots of books written on what you should buy, but that also needs a very good clarity of thought around which, in fact, very few books are written, if at all, around what you should sell, why.
So just to clarify, Rakshit, you're saying all the stocks you've discussed so far demonstrated conviction. It is quite possible that, say, 12 months down the line, 18 months down the line, one of which shows some new insight, which damages that conviction and ends up becoming seeing a sell action in the portfolio, right? Which is why we call ourselves as portfolio managers. It's never the case that you'll get 100% of the stocks right. The whole idea of having a portfolio is to diversify risk. And Rakshit has beautifully explained why there is a limit to the risk reduction through diversification, and why there is something called optimal diversification. That brings us to also our favorite question. The fact that we've totally dumped market timing is clearly hurt. One could argue that if you had a knack for timing the market. Maybe you could have prevented some of this off period, holiday period, whatever it is. Why don't we factor in things like investor sentiment, technical analysis, to sort of reduce this sort of volatility in the portfolio performance? In fact, we invest the amount given by the investor in a lump sum rather than sitting on cash and waiting for it. Perhaps that could have limited the underperformance somewhat. What do we have to say to that?
Right. So no, that's a valid question, but a very clear answer if you think about it. So two parts to answering this. Part number one, when it comes to benefits of timing, right? If you can time the entry and exit points preemptively, as in before a share price rises, if you can enter, before it falls, if you can exit. If you can do that preemptively, certainly, I mean, you'll be obviously, one, you'll be God, and secondly, you'll benefit the most out of the volatility in share prices in the market, right? The challenge with that is it's very difficult to do. So, for instance, if you had exited from let's say our portfolio or even broader equities prior to COVID, saying that, look, as the COVID wave deepens, the economy is going to get shafted and we should not be investing in equities. Well, you were proven horribly wrong. There was a correction, but that was followed by a massive rally. Now, had you looked at that rally and said, well, if this is how it happens, then the moment delta wave comes, I will wait for a correction and buy at a low point because that will be followed by a rally. During the delta wave, the intensity of the wave was even more severe, but there was no correction, right? And that's one example. There are hundreds of such examples. Why the logic of the event, which you think might have a connection via the economy to the stock market and via the stock market to your holding portfolio, that logic on paper might be quite sound. It doesn't play out like that, right? And that lack of the logic working out from the macro event to the economy, from economy to stock market, from stock market to your portfolio, is the reason why this is actually a very difficult thing to do in a preemptive way. What we do go through is reactive rebalancing, which we call as post facto rebalancing, which is where we say that, look, we can't capture half of the story. A Bajaj Finance falling down because of some reason that we couldn't preempt, we certainly can't sit in cash when the fall happens. But after the fall, we can buy more of it if we are very convinced. And then we can actually benefit from the rise, the recovery, if the fall was unjustified, right? In the first instance, if we were holding on to a stock that had a justified share price fall because the fundamentals of the company had deteriorated, it's a mistake. It's not called timing or anything. Holding on to a Bajaj Finance, if it is heading towards disaster, is a mistake. But holding on to a Bajaj Finance and not being able to time a crash is only half the story, because you can actually buy more of it after the crash and benefit from the upside. And this piece, the post facto rebalancing, which is half of the timing benefit rather than the whole of it, has added massive alpha, more than 200 bips alpha since inception of CCP annually to our performance. Right? So that's one part of the answer. The second part of the answer is that, look, in 4 out of 5 instances, not timing entry exits helps you in high quality stocks. In 1 out of 5, you might not be able to benefit from the sort of fortitude that you could have had you preempted the fall precisely, right? if the share prices are going to be reflective of fundamentals in the long run, and if the fundamentals are highly consistent and healthy, both in the long and the short run, then more often than not, the share prices will be reflective of healthy fundamentals than otherwise. That's not going to be the story with the rest of the market. And again, whether it be the 2016 stock market crash of February, or the demonetization, or the COVID crash, or 2018, when there was a massive crash after the capital gains tax was introduced, in all these events, anybody who tried to time and wait for a better entry point in high quality portfolios like the CCP, they had an adverse impact of the timing attempt. But yes, in one of several instances, which was the last 12 months, somebody who was sitting on cash might have a smile on their face. But net over a 3, 5, 7-year period, timing entry exit has more adverse outcomes than favorable outcomes in high quality portfolios, right? Obviously linked to the fact that fundamentals keep compounding and timing is not something that that becomes rewarding as a result.
Yeah, I mean, like they say, it's easier said than done. We all would love to time ourselves to perfection at the bottom. And unfortunately, at the bottom, not many of our clients will have the courage to put in the money, as we're seeing today. While your data suggests that we've had earnings compounding quite strongly, but the stocks are down, which means that if at all, they've gotten cheaper over this period. This is as good a time to put in more money. But the news flow around obviously is quite distractive, and therefore, we do recommend a more systematic approach to investing. Do not try and time it, but at least we don't attempt to do something that we are not qualified to do. Through that rebalancing answer, Rakshit, you've sort of preempted a few questions which are all related, so I'll just sum up the answer myself. The question is, how are you taking action to this performance issues? So we are rebalancing, we are buying stocks which have fallen unjustifiably. Some of you have also said that, look, despite the conviction you've stored in some of the stocks, I can see some sell trades on the same stocks. I guess that's a result of the rebalancing. But one aspect of the rebalancing is saying that, look, if all the stocks are going down, where is the scope to rebalance?
Yeah, so all the stocks don't go down at the same time. So even though it is a fact that the last 12 months, most stocks have gone down, but they've all gone down at different times, which gives you the opportunity to benefit from the dislocation. So 9 months ago, Dr. Lal fell, but Bajaj Finance went up, right? 2 months ago, Titan went up, but Bajaj Finance fell. In the month of June, Titan fell and Page Industries was going up. And 2 or 3 months ago, Page Industries fell when now HDFC Bank is going up, right? So if all of them were going down together, then you would be right that this exercise cannot be done without top-ups from clients, and it cannot be done in an existing portfolio. But it's not always entirely correlated. Most often than not, it is uncorrelated over a 2-month window, if you look at it. And 2-month window is a long enough window for the deviation to become attractive enough for us to rebalance the portfolio and benefit from it.
Yeah, so question about, again, timing. When will this turn around? When will stock prices catch up to the fundamentals again? I think you can take the next one also together, in the sense, what does this mean for long-term return expectations? If, say, the portfolio hasn't moved in 18 months, and if I have a 5-year horizon from the time I invested, do I still see the sort of mid to high teen sort of return expectations from a 5-year perspective from the time of investment?
Right. So the first question is obviously a $1 trillion question. If anybody has an answer to that, obviously they'll be very rich in the next 1 year. But no, it's difficult to answer that precisely. The only perspective that I think is worth sharing is if you slice and dice the last 12 months itself into 3 phases. Phase 1 was Jan to June, where if you didn't hold commodity producers, you underperformed and probably delivered weak absolute returns, just like CCP did. But that was followed by a 3-month period where the entire irrationality of Jan to June reversed between June to September. It took less than 3 months for CCP to go up by about 20% in absolute terms and in relative terms by about 9% alpha during July, August, September. Right? That's how quickly and how sharply the irrationality reversed. That was obviously followed by the next 4 months, which is why in the last 4 months we've delivered another underperformance of 10%, which is largely the entire underperformance of the last 12 to 18 months. And this irrationality will also reverse. When does it reverse? We don't know. This month, after 3 months, after 6 months, or a bit longer, but certainly not these irrational periods. They don't take 3, 5, 7 years to reverse. So to answer the second question next, the 5-year perspective doesn't change because of a 12-month or a 6-month or an 18-month period of irrationality, right? And this is where actually going back to the webinar that we did a month ago about the psychological parts of investing in high quality portfolios. If you take a 5-year investment horizon, then actually in a portfolio like this or many other high quality portfolios run by reputed fund managers for several decades globally, you haven't been disappointed provided the fund manager picked up fundamentals which compounded at healthy rate. Because a 5-year perspective is not driven by a PE compression or expansion. Mathematically, you can see it, how insignificant the PE multiple moves become over a 5-year period. And logically, you can see that if the fundamentals keep compounding, then quite clearly the intrinsic values can't be falling, provided the companies keep reinvesting to drive growth into the longer term future consistently. When you look at this portfolio, the 5-year compounding run rate hasn't moderated, whether you look at the profit after tax or free cash flow. In fact, from the capital allocation decisions that my colleagues talked about that have been taken in the businesses over the last couple of years, those capital allocation decisions have elongated the runway and accelerated the growth rates that we look out for over the next 3 to 5 years from these companies. And that acceleration of growth and elongation of runway of growth is actually not going to mean that the future growth rates of share prices will be the same as what they would have been without these capital allocation decisions. So in fact, as I said, we are excited as much as using that term, rather than being worried or concerned because of the share price. We are excited about how the fundamentals are progressing here. And 5-year perspective, you shouldn't have any concerns regardless of when you started investing in a high quality portfolio like this.
Fair enough. That's it about the portfolio questions. A few questions quickly we can take on the stock specifics, most of which we've covered. We'll try and clarify on some of those. So there are 2 different people who are asking about similar aspect of our philosophy. So we're basing a lot of our conviction on Bajaj Finance based on their investments in technology in terms of sustaining the franchise value. Similarly, we're basing our conviction on long-term free cash flow growth for Asian Paints on their ability to allocate capital, where they've expanded into home decor business. What if these initiatives fail? What if the tech initiative of Bajaj Finance fails? What does it mean for long-term intrinsic value assessment of ours? Or what if the home decor business of Asian Paints fail? What does it mean for the intrinsic value assessment of Asian Paints? I mean, this you can apply to all of our other stocks, right? It's a consistent theme. A lot of our almost all of our companies are investing for the future, which underpins our expectations of longevity and in turn the intrinsic value. Naturally, all of these are vulnerable to failure. How do we factor that in?
Yeah, so let me first talk about a few failures which have happened. So Titan, the same company about whom Devin talked about on Carrot Lane, Titan's eyewear business for the first 10 years was in a way a loss-making franchise, and you can call it a failure for that 10-year period. Titan's perfume business hasn't scaled up so much. Asian Paints' international forays can be called failures because whether it be Berger International acquisition of 2001, or even prior to that and more recently in the last 10 years as well, they haven't delivered. So there are many initiatives which fail for these companies. But again, going back to our longevity framework, you'll get the answer very clearly through that. We're looking at three components in any of our portfolio companies. Component number one is here and now pricing power should be good. That's the presence of the moat, right? Which for an Asian Paints is not defined by home decor, which for a Bajaj Finance is not defined by the fintech initiatives. For a Bajaj Finance, the here and now moat competitive advantages are defined by its core lending business and credit strengths that it possesses, the operational strengths that are also linked to tech investments, which it has already done, but not linked to fintech. Asian Paints' current moat is defined by its paint business and its ability to fortify that. Home decor doesn't contribute to the current moat of Asian Paints, the way we look at it, right? And so on and so forth. The second piece on any company that we look for is capital allocation decisions in three different buckets. One, strengthening the current core to deliver competitive advantages over the next, say, 3 to 5 years, which means what makes us believe that Asian Paints' paint industry dominance and cash generation will not be challenged in the next 5 years. Titan's jewelry revenues from Tanishq, not Carrot Lane, will not be challenged in the next 5 years. Bajaj Finance's lending capabilities will not be challenged in the next 5 years. That's one part of capital allocation decision, which is again linked to code, not linked to new initiative success. Then comes the second part, which is new revenue growth drivers. Are they getting added? If yes, then it has to be done via experiments. And we are very conscious of the fact that 2 out of 3 experiments or 4 out of 5 experiments of most of our portfolio companies will fail. But 1 out of 5 experiment that succeeds should be a game changer for the number of revenue growth drivers and their strength in future, right? So it's all right for an Asian Paints' international foray to not work out as long as those experiments continue. And it's all right for a Sleek and an SS to not work out for the first 5-6 years, as long as that acquisition actually leads to maybe a stronger home decor foray, right? This is how a Page Industries went from an innerwear company to also being a loungewear business successfully. I can guarantee you 10 years ago, had you looked at Jockey and somebody had told you that there are going to be t-shirts and track pants of Jockey sold to you, you would have never accepted that an innerwear logo you will be wearing on your outerwear. That too when you're sitting in a plane rather than just going down for a walk after dinner, right? This is the success of repeatedly trying. Jockey failed in kidswear twice before the recent attempt, which is a far more successful one. But that failed kidswear attempt was one of many experiments, out of which loungewear became a successful outcome, right? This experimentation is important. If it doesn't happen, then you'll be a Colgate selling toothpastes all your life. Industry growth saturates, growth potential is gone, and then there is nothing for shareholders to benefit from. You'll be say a Castrol doing nothing new, and after 10, 15 years of good run, a Castrol's growth runway saturates, right? Asian Paints 6 years ago was more than 50% market share in the organized paint industry. It is certainly going to saturate if it doesn't add new revenue growth drivers. So it's that second element which we track. If there is no success, we don't give scores and allocation for that via the intrinsic value margin of safety. But if there is success, it's worth bearing that in mind. And CaratLane is a success. If you as investors ignore CaratLane, it's a successful franchise which you're not adding to your intrinsic value, right? But yes, until it was a success, it didn't make sense to add it to your intrinsic value as investors. And the final piece on capital allocation is radical disruption. If these businesses are not disruptors, then the phygital of jewelry will be done by somebody other than Titan. If these businesses are not disruptors, then the live space or a home lane will take away the paint business from Asian Paints. If these businesses are not disruptors, then fintech will be done by somebody other than Bajaj Finance, and the growth runway will be saturated or disrupted, right? For you to be a disruptor, such initiatives are important. Not all will be successful. Some will be. It's our job as analysts to then understand where is the success and can we actually get convinced about it. And this is not sort of blue sky thinking. This is you have to factor it in only after you're convinced that there's massive value getting added to a customer in a way that competition can't replicate through a new initiative.
Great, thanks, Rakshit. Sudhanshu, question on Divis. This question is saying that there are a lot of drugs coming off patent from 2023. Isn't that a great opportunity for Divis? How is Divis positioned to have that opportunity? And is it just Divis only or other API manufacturers as well? Apparently, it's a $20 billion opportunity.
Yeah. So basically, this is an opportunity which has been highlighted by the management as well. So there are many drugs which are coming off patent. Management has highlighted 6 particular molecules or 6 strategies. One of which is basically capitalizing on this patent expiry. The opportunity size, which is relevant for Divis, because of the drugs which are coming off patent, many are not in the capability pool for Divis. Some of them are large molecules, which are more biologics than chemistry molecules. So the relevant molecules have an end market of $20 billion sales as they stand currently under their patent protection. Now, Divis, as I mentioned in my remarks regarding the performance of the company, Divis has already filed several DMFs which cover these products which are going off patent from 23 to 25. Now, this is exactly the play which Divis is making. Regulatory approvals and the patent expiry are the 2 things that we are awaiting for Divis to start commercial supplies for these molecules. Client validations for several of them are already underway. So that's, as the client is mentioning, this is a great opportunity for Divis to capitalize on, and they're exactly working on the similar lines to get the most benefit out of that.
Right. On Dr. Lal's, it's a question that you implied that there is a broader slowdown in healthcare spending if based on that IMS report post-pandemic. Do you see that data reflect in, say, pharmaceutical sales growth or hospital footfall and so on? Because it can't be diagnostics only with the same trend.
Yeah. So data for hospital OPDs obviously is not available because there is no centralized database, but we see that in the pharma sales. So last 1 year, domestic pharma volumes have degrown by close to 2%. And even if you look at the 3-year CAGR, so pre-COVID, the pharma industry used to grow at 5-6% in volume terms. That number is down to around 1.8% in the last 2 years. So yes, it is reflected in the pharma sales as well.
Also, some of the channel checks that we've done suggest that even hospital footfalls and OPD footfalls have been moderate after the Omicron wave. They were all expected to pick up after the Omicron wave because everybody postponed many of the discretionary aspects of healthcare during the COVID waves. But in the last couple of quarters as well, it hasn't yet picked up, but that's expected to be a temporary phenomenon.
Great. And last question on Nestle. Says that even the longer term trajectory in terms of growth has been fairly modest. Why do we retain the conviction here?
Yeah, so I think Nestle again is a business which has underwent kind of transformation in the last 4 or 5 years. In fact, in the recently reported results yesterday, they have reported a sales growth of 15%, which is one of the highest they've ever delivered in the last 10 years. So there are 2-3 things which give us confidence about the long-term growth in this company. One is mainly if we talk about the product portfolios, all of them are highly underpenetrated product portfolios, either in terms of overall category size. For example, infant nutrition is an underpenetrated product in India, or in terms of distribution. For example, 80% of Nestle sales comes from the larger cities, metros, tier 1 towns. And in the last 3-4 years, that's one point where they have focused a lot, which is expanding their sales and distribution. So in the last, if I recollect, in the last 3 years, the touch points in rural areas have almost increased by 30-40%. So this is accelerating the growth rate for Nestle India. At the same time, it's not just infant nutrition, Maggi, KitKat, Nescafe, which is today. They're also adding new categories to the business. So 2 quarters ago, they added pet food, which is an industry industry is itself growing at 20-25% CAGR. They added another premium infant nutrition brand, which is called Gerber, to their portfolio. So these 3 things give us the confidence about the business. It was not there in today's pack because it reported results yesterday.
So just to highlight the transformation that Deven is mentioning, it's the efficiency, the operating efficiency of Nestle that has totally transformed in the last 4 or 5 years under Suresh Narayanan. If you notice the EBITDA margin expansion, it's about 120 to 140 bips per year, consistently over the last 4 years, 5 years. Right, and that is coming from sweating of assets harder, launching of new capacity, expansion in factories which are far more automated, and sort of better processes and systems to run the sales at the front end and ops of the whole business. And these are structural changes. Nestle was, in a way, a much more inefficient business with good products, great brand recall, etc. Prior to the Maggi fiasco, and after Suresh Narayanan came in 2016, all these inefficiencies have been one by one taken out, and the cash generation as a result remains very healthy. Although you're right in asking the question that the revenue growth run rate has been pretty modest. That's not the case for free cash flows or for profit after tax for the last 5-6 years. And most importantly, more recently, they've accelerated CapEx, which will feed into all the initiatives that Deven was talking about, new products, newer initiatives, deeper penetration, capitalization, etc.
Great. Thanks, guys. Thanks, Rakshit. Thanks, Deven. Thanks, Danshu. And thanks to all of our clients who dialed in. We'll be back in a month's time with the next CCP webinar. Hopefully, we'll cover a number of stocks we didn't cover this time, given the paucity of time. But thanks for dialing in. See you again.
Thank you.